Hello, everyone. Welcome to the Market Breath. And let's just dive right into this. This has been an incredible week. I just want to go through a bunch of quick charts. This isn't a tutorial necessarily, because I would just want to nail home the point that this week was incredibly bullish. It's almost the mirror image of the bearishness we had in October. If you read my blog at drdrew.com/122, you will have followed along this whole trail and seen how the indicators of market breadth have guided the trading this entire way. So let's start in here with the S&P 500. Some key things to note: this blue line is the 200-day moving average. Today, the index jumped 1.9% for a clean 200-day moving average breakout. It now has left behind this line that defined the summer of loving stocks. So we're back into gains from the summer. We're even poking, or the index is even poking above this pre-Jackson Hole high. Now, this is very bullish, this whole trading action this week, because you can see we've been up 4 straight days. That's this entire week, but we're still in this downtrend channel from the last high. So what's a downtrend channel? It's a set of lower lows and lower highs. So the index is not truly bullish until it can get this breakout above the last high. But until then, I still think there's room to buy dips. For instance, I'm expecting this 200-day moving average support to hold. Okay, let's take a look at the NASDAQ. Similarly, the NASDAQ actually did its 200-day moving average breakout yesterday. Yesterday was Wednesday, and that was the Fed day. And that I treated as my confirmation that the oversold bounce was well underway. And the reason why this was doubly important, and sorry, the text is a little off there. Let me show you. This line was the bear market line for the NASDAQ, meaning 20% below the all-time high. And this, of course, this action here was extremely bearish. But notice, and this is why confirmations are important, while the NASDAQ did break down below the 200-day moving average, it never had another low below that. So that breakdown was never confirmed. And what happened after that? Buyers stepped right in. In fact, even better than the S&P 500, it's now 5 straight days of gains. So much so that now the NASDAQ is even above its 20-day moving average. Now, it too is still struggling with lower lows and lower highs, but it looks like the candidate most likely to do the breakout. So keep an eye on that one. Even as I speak, Apple is down, I think 2 or 3% post earnings. I wouldn't even worry about that because Apple, I'll just switch over really quickly. Apple has also broken out above its 200-day moving average, and it can come down to the 200-day moving average and still be a part of the bullish bounce here for the oversold bounce. And you can see on TradingView, it's showing the aftermarket action. So we're currently at 172, and you can see here where my cursor is that the 200-day moving average is around 171.32. So, you know, Apple, it could even go down to 170 and still not make me change my overall opinion. So anyway, let's go back now to the other major index, which is IWM, small caps from the Russell 2000 ETF. Sorry for the text here getting in the way. Let's just pop that downward so I can go bottom. Now it's easier to see. And look at that. You know, I have refused to pay any more attention to IWM because it's just been accelerating practically downwards, even below this pre-pandemic high. That was pretty bearish to me. And now today, all at once, 2.7% gain, and it's breaking out above both its pre-pandemic high and the 20-day moving average downtrend. This is very bullish for small caps. I want to see one more close above that, and then I'm all good with trading in IWM again. I do kind of regret missing this move, but I'm all good because of all the other trades I did. And again, the blog explains more that my main purpose here is just to go through some charts that really are very indicative of the trading action. And I had to write down a bunch of them. Usually I just do them off the top of my head, but there are so many good messages here. So finally, market breadth, which is what I'm all about, and that's what guides my trading. This is the percentage of stocks above their 50-day moving average. TradingView calls it MMFI. I call it AT50 for above the 50. Hopefully you see this right away. This market breadth indicator just exploded higher today. I mean, just exploded. 50% on a percentage basis. I don't pay attention to that so much, but just look at this. It closed yesterday at 24% and closed today at 36%. And that's the highest close it's had since, wow, look at that, since 2 months ago, essentially 2 months. This is extremely bullish. Even with a pullback, those pullbacks have to be bought. Again, back, down to support levels. So the oversold period is definitively over. For those of you, again, who follow the blog, I have to keep promoting it, drduru.com/122. I talked about how, given the bearish tones of how long this oversold period was lasting, one coping capability for trading in that bearish sentiment as this oversold period dragged on, it was to wait until the oversold period ended. Well, that happened on Tuesday, and I got very active Wednesday, even before and definitely after the Federal Reserve. So this is amazing. And let's just take a look at the percentage of stocks above the 200-day moving average just to see. And yep, this confirms it. It also exploded higher, and it's actually essentially ended this downtrend defined by this line. So you have to follow these indicators to say that sentiment this week has taken a sharp shift from bearish to bullish, with, of course, pending and outstanding confirmations to go. So another thing to mention is, well, why in the world did the market switch so much? Well, we had a bunch of things happen this week. We had the Federal Reserve. For some reason, people thought there was still a chance that they were going to hike. I didn't believe it. So I came out of the Federal Reserve meeting on Wednesday thinking there was no new news, but the market clearly treated it as news. The Fed did not hike. The Fed did not give any definitive plans for a future hike. And, going into the meeting, the, the Fed fund futures even told us that the market didn't expect any more hikes. So fortunately, I was already bullish on the market, but I was just surprised to see that was the headline. Ooh, big news flash. Fed is probably done with rate hikes. Okay, fine. We got the confirmation, and that, of course, provides price support. Perhaps even more importantly, though, was the action in the bond market. Bond yields plunged, and stocks love lower yields. Let's look at TLT. And what I heard is that, and I don't really follow these auctions for government debt, but what I heard and what was interpreted is that the big, massive funding round that the government rolled out yesterday, Wednesday morning, went well. So that set the stage for a very positive interpretation of the Fed. So TLT is the 20-plus year Treasury bond. I think it's like a mix of long-term bonds. It jumped almost 2% today. So price is higher, means yields lower. That's extremely bullish for the stock market. Just as a hedge, I went ahead and bought a January put on this just to cover the backside. So I think going forward with earnings season well underway, I think the only thing, so I shouldn't say only, the main thing that could undermine this bullish sentiment is something that turns bond yields back downward. But I think that, bond yields have peaked for now, and that if there is a pullback, it's going to stop around this area. But again, I feel more comfortable having that put in place. Okay, so those were the key market indicators. As you know, I love Swing Trade Bot. I'm a subscriber. I just want to go here and look at the general market overview just to confirm my impression that that things are really bullish. So sure enough, short-term indicators are all turned up. Mid-term indicators are turning. We're all down. Now there's a little bit of a mix with the NASDAQ 100 now flat. Long-term is now turned up again. And this is because of I think because of the 200-day moving average. Let's just take a look at some other indicators to just look at how bullish today was. You can see new highs. It's not a lot of them, but it's a lot more than the new lows. Bullish signals. This is the outstanding one. 43, almost 4,400 bullish signals versus just 1,700 bearish signals. And understand that there is some overlap in these things, but that again is just another confirmation. Swing Trade Bot also has this percent of its own calculation of the percent of stocks above their 50-day moving averages. You can see here the big breakout from Swing Trade Bot. So it looks like we're probably good for not dipping oversold without some, other big new catalyst. So again, I'm all about my market breadth. This breakout must be respected by bulls and bears alike. And I think that's good because, like I said, I'm not going through a tutorial on scans. So I think that's good for now for Swing Trade Bot. So let me just take you through some quick charts because there's a lot of stories to tell here. And I don't have a specific script. So bear with me as I go through some individual stocks, and the narrative may jump around a little bit. So Caterpillar, as readers of the blog know, drduru.com/122. I use Caterpillar as a hedge on bullishness. It worked out big time last week. And earnings kind of confirmed that what sellers were afraid of. So here you can see CAT dropped a whole 6.6%. Now, because I was bullish by this time, I was not going to put in a bearish pre-earnings bet. I felt like I already had covered the profits I needed on my earlier hedge. So I just waited to see what would happen. But now I suspect CAT is getting ready to be bullish again because, after the Fed, it jumped 2.6%, and today it's at 3%. I mean, in no time, it's going to be above the 200-day moving average again. So I'm keeping a close eye on CAT as an indicator of market sentiment. If it struggles here at the 200-day moving average as resistance and turns back, then boom, I'm back in it with a put as a hedge against my general bullishness. Let's look at Tesla. Tesla also flipped from bearish to, well, not quite bullish, but it looks promising. This breakdown here, I drew a line. So, Tesla back in May had this nice breakout. It only lasted for about almost 2 months of gains, but it still changed the tone, and it confirmed the market tone for the summer as being bullish. And even when it pulled back after earnings, it stopped on a dime right at the breakout point of support and rebounded smartly. Now, was I smart enough to catch this rebound? No, I wasn't. I think maybe I had 1 or 2 trades in here, but even though, gosh, I can't remember exactly what my trading call was. But anyway, this is one of those times where definitely looking backwards, it was so obvious just to go all in on this, particularly after it bounced 7%. I know that's a big move, but that kind of confirmed support. And then down here, this breakdown here made it look like Tesla was bearish and getting ready to just continue to plunge down to its lows, but it turned on a dime. I don't think because of any Tesla factors, but because the market is now bullish. And so that's helping to pull Tesla back up. It's at it right at the 200-day moving average. So let's see what happens there. If it starts to struggle, if it closes below today's, say, intraday low, I'm going to assume that that's bearish for Tesla at least, and I might even use it as a hedge. Okay, let's keep it moving. I have a logistics stock, XPO, and this was interesting to me because you can see even as the market swooned from August through October, it kind of held in there pretty well with this tight range. And on earnings, it jumped 15%. A logistics company jumping 15% after earnings, that told me, yes, that was another confirmation signal that I used that, yes, it is a good time to be bullish. And you can see that generally buyers are trickling back into XPO. I think this point, actually, let's just go ahead and look. I think, is it at all-time highs? Let's look at the monthly. Yeah, this is all-time highs. So a logistics company playing around with all-time highs, that's just bullish for the economy and the stock market overall. Although I'm not going to go so far as to say that this is the indicator, of course. Okay, so speaking of logistics and stuff like that, let's go to FedEx. This is another important stock. I won't go into all the writings I've done on this one, but you can see here, FedEx broke down below its 200-day moving average. I happen to have a put spread on this, but by this point, I treated it as a hedge to my bullishness on the market. So I did not take profits. I mean, looking back, of course, I wish I had, but I'm more than happy to get the loss on that put spread because of all of the other bullish plays that worked out after this. And this is again, I said I wasn't doing tutorial, but actually there are some tutorial moments here. This is again another example of why waiting for confirmations of big moves can work out pretty well, because FedEx never closed lower than this, and so that 200-day moving average was never confirmed. On the flip side, it did confirm the 200-day moving average breakout. And let me just switch to the 50-day moving average really quickly to see where that is. Sorry I had to do this, but TradingView limited the capabilities of the free version, so I had to flip back and forth. So you can see I flipped the moving average to 50-day, and there's still room to go for FedEx to hit that. So maybe around 252, 253. And let's see if buyers are still enthusiastic at that point. If not, again, for a short-term trade, it's worthwhile to play a pullback to 200-day moving average support. Okay. Let's keep it moving. Home builders. I wrote about home builders on Seeking Alpha. There's a lot to say here. I'm trying to move quickly, so I won't go into too much detail about the fundamental factors that are supporting this. But I will be writing in my housing market review soon about some of this. But you can see that the plunge in rates has definitely helped a rate-sensitive industry like home builders. And ITB, which is the ETF for home construction, which is mostly home builders, just exploded to the upside. So yesterday, I mean, it was all I could do to catch one home builder yesterday. I mean, it surged 3.5%. I was thinking I might have a little bit of time to dabble in some others, but I had to chase it today. So now this is a 200-day moving average breakout. Notice I'm not waiting for confirmation on this one. There are reasons for that again, I can't go into because it's a lot of fundamental stuff. I'm going to be writing about it soon. So this was just absolutely amazing. Home builders are turning on a dime from this long bearish swoon to now what looks like it's bullish. And this one, this is the home builder that I wrote about on Seeking Alpha, and notice that I couldn't find any reasons to be bearish. I was pretty amazed at how bullish the earnings were. And sure enough, this is MI Homes, ticker symbol MHO. It held 200-day moving average support, and it has not looked back since. That's pretty amazing. All right, here's another stock. Let's go to some tech stocks. FSLY had earnings today. This is another one where you have to note that sometimes, the market acts like it really has no clue what's going on. Back in August, FSLY surged 23% post earnings. That looked pretty bullish. And while the stock swooned a little bit afterwards, it did continue higher. But then, it stopped on a dime right with the market's peak. I think this was the market's peak, right at September 1st, and sellers just went to town on it. And now we have earnings again, and the stock surges. Well, it closed at 15.6% after swooning, but I think it was up as much as 25%. And then sellers started descending on it. So what gives? Is this company doing well or not? Well, I didn't look into the earnings. I'm just looking at the technicals. I just went ahead and bought a few call options, speculatives, expiring next Friday, just in anticipation of support holding. But this is just a presumption, given there's general bullish sentiment in the market. I could, of course, be flat out wrong. Okay, AMD. Oh my goodness, this one is amazing. I was worried about AMD because it did confirm a 200-day moving average breakdown, but it hasn't looked back since. So this was a false breakdown. How can you tell a false breakdown? You can only tell a false breakdown after the fact. And earnings just confirm that AMD is still all good. I mean, it surged almost 10%. So it's back in bullish territory. Given that the market is bullish, I want to buy the pullbacks if the market gives any on AMD. And again, I'm only good as far as the 200-day moving average as support. Okay, the next one on my list, let's go for Logitech. I think this says it all. Earnings up 13%, and buyers have generally just been trickling in step by step by step. I am long Logitech, but I'm also a long suffering holder of Logitech. And why do I say long suffering? Because this all looks good for this year. But if I go back a little bit further, like monthly, oh, too far monthly. Let's just do weekly. You can see that, Logitech has had a really rough time since 2021. I think I bought somewhere in here thinking that this support would hold. So I'm crossing my fingers that the current momentum continues and I can get back to even. Fortunately, I did buy more somewhere down here. I can't quite remember. So I lowered my cost basis to make this an even better trade. So I showed you AMD. I should have moved to Nvidia right after that. This is classic, folks. There's I'm sure there are a lot of people making a big deal out of this head and shoulders pattern. I even wrote about it, but I also wrote, and my trading friend, Trader Mike, the owner and creator of Swing Trade Bot, reminded me that it's hard to find a head and shoulders bearish top that actually works out. And I literally think that there must be trading bots out there that are counter head and shoulders trading, because invariably either the neckline of the head and shoulders will hold a support and then you never get the confirmation of a top, or a breakdown happens and it tricks a bunch of bears and then the thing flips right around. Well, that's what's happened with Nvidia. So here's the left shoulder, the head, the right shoulder. Here's the neck. Below the neck is bearish. You can see the first bounce here, sellers took it right to the edge and then buyers came right in. Then the sellers punched it down below the neckline, but then buyers pushed it right back there. So you can see how important this neckline has been to these trading bots that seem to be counter head and shoulders, and now it's off to the races. Needless to say, I bought call options on Nvidia yesterday. I think it was either right before or right after the Fed, and then I sold it here at the 20-day moving average resistance. But because of this, I know this looks like tiny moves, but for the call options, these are huge moves. So I was really happy that I caught that one. All right, let's keep it moving. Bad news for this HR software company, Paycom Software. It had, of course, a big rebound today because it's following all the short covering and change in sentiment. But for earnings, oh my gosh, it plunged 38%. That's a significant change in the business. Whenever I see something like that, I like to go back far enough to get some perspective. And sure enough, I mean, this takes the stock past the low of the pandemic, which to me is surprising because I doubt. So if this thing is following the economy, then this looks way overdone. But if there's something very company specific that's flawed, then okay, fine. But you can see because of the bullish sentiment, buyers looked at this and took this as a sign to buy Paycom at least back up to its pandemic low. So let's see what happens. I think if I go back to the daily, you can see that if you're a quick trader, you want to buy this one at least up to the lower Bollinger Band. Again, the Bollinger Bands define the 2 sigma price volatility around the 20-day moving average. And, this is just so overdone, it's bound to rubber band back up. But once it gets back to the more normal range of volatility, you have to be very careful from that point on, because the people who got trapped by this big plunge will now start to look, oh my gosh, let me just take, now that my losses are reduced, let me just get out of here now. So there's going to be a lot of that kind of battling. I've got this one on my list because, as you know, extreme moves to the upside or to the downside attract me. That's just part of the market breadth calling. All right, so next on my list, oh yes, I've got penance to pay for Wingstop. Again, I wrote about this one on my blog. I ignored this analyst upgrade to 200. I insisted that all this churning here would exhaust the buyers and that Wingstop would follow consumer discretionary back down to this level. Yeah, I couldn't understand why it sold off and then turned on a dime. Well, somebody knew something. Earnings was amazing, 7.5% surge. And even though it's well above the upper Bollinger Band, which again means it's very stretched, buyers continued pushing into it. I know Wingstop has a decent amount of short interest, so that could be what's at play, but still, I was just flat out wrong here. Lesson for me is, you know, while having narratives are good, paying attention and deferring and respecting the price action and the technicals is even better. And what I refuse to pay attention to is that this churn was not exhausting buyers. This churn was showing that the stock was resilient as it pivoted around the 200-day and the 20-day moving average. And, you know, at the bare minimum, I wouldn't have been caught with a put spread before earnings, but I just had in my mind, my narrative said, oh, the exact opposite was going to happen. So that was a big fail on my part. Now that I put it in here, I don't have to write about it. Garmin, let's just do a few more and then I'm going to end this. Garmin was interesting. You know, Garmin never ceases to amaze me. I don't understand where it still sells its navigation products. I need to look into that, but Garmin just keeps ticking. Like yesterday, big move, 10% post earnings. It's broken out, so it's bullish. Of course, let's get some perspective. And sure enough, Garmin has had a hard time since 2021, but it is grinding higher. I like this one. It's on my buy list for dips. If I want to be extremely cautious, then, you know, my stop level would be maybe below this last high. You know, I like to have those kind of stop levels because what if all of a sudden the fundamentals turn against Garmin again and whatever brought it down to this point reactivates. Okay, let's go to another one. Oh, yeah. Oh, my gosh. More pennants. DoorDash. I wrote a bearish article in Seeking Alpha about DoorDash. I'm still bearish, but the pennants here is just an irony of not sticking to a trading thesis. And again, this is a tutorial moment. I recognize that, you know, there's a lot of bull bear battles about DoorDash, and you can check me out on Seeking Alpha under Dr. Duru to see what I wrote. And you know what I wrote, I don't think it's changed. This last earnings results has changed, even though the earnings in of itself was very bullish. But I just don't see the longer term viability. Sorry, not viability of the company, but I don't see paying a premium for this kind of company. Anyway, once DoorDash failed to break down below the 200-day moving average, I had to respect the price action. So this is a place actually where I did respect the pricing action. I said, okay, being bearish is not good. Even if I think earnings is going to be a disaster for Dash, I have to respect the pricing action. So what I did was very well-balanced move. I bought a put spread and a call option. And actually, I think I did a calendar call and positioned it so that the short side expired last Friday, and then I had the long side. So let me make sure I got my dates right here. So yes, Monday was a good day. DoorDash popped up, and I had a small profit on my call option. And I said, you know what? Let me just go ahead and take the profit now, and I'll keep the put option as a hedge on my other position. That was my excuse now for suddenly turning from balanced back to essentially bearish on DoorDash from a technical standpoint. And so this was just a big regret. I had a 75 call option expiring tomorrow, and DoorDash closed today at, let's just say 88. You do the math. My strike was 75 and Dash closed at 88. And I left all of that on the table because I prematurely pulled the plug on a trading thesis. And that trading thesis was so right, but I was so wrong in the execution. Tutorial moment. Okay, let's see what else we have. Yeah, so just a few more. I know I said that before, but let's go to Informatica, which is an old school data analytics company. I'm an old school data analytics person, so I can appreciate this one. Informatica, sorry, made it on my previous scans, bullish scans that I did earlier when the market was in a bullish mood. And I did not actually stop out of this one because I really kind of liked the story and like what I was seeing. I actually added more as it came down here. And I took a risk and I held through earnings, and I got rewarded with a 18% surge upwards. I'm not saying I'm smart. This was a little bit of luck, crossing my fingers, but I am glad I held on. I went ahead and took profits here, and I'm just going to keep Informatica on my radar. Actually, this one I'm so interested in. I really do want to dive into the earnings, and maybe I'll write something on Seeking Alpha about it. Okay, and then one last one, which is on the bad news side, which is Cognizant. I was surprised to see. Well, actually, it's not so bad. I hadn't looked at it after a gap down post earnings, but notice that it is struggling here, 200-day moving average resistance, and the 20-day moving average is coming straight down to converge as more resistance. So that's something to be careful of there. I have it on my list now to see. These IT companies are important to keep an eye on because of the implications for the rest of the industry. Speaking of IT, I'm going to call an audible and look at CDW. This one is ironic to me in multiple ways because when it did this earnings warning and dropped 13%, so all sorts of bears, I should say all sorts of bears. One particular bear I saw was saying this is an indicator of weakness in enterprise spending, blah, 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 blah. Now, all that made sense in the moment, but the market proceeded to act like it didn't indicate anything. Even after the company reported earnings and the stock dipped down a little bit, buyers just took over. And again, if you're respecting the price action, if you're respecting the technicals, you had to be concerned as a bear as it just kept trending up. You had to get out as a bear once it confirmed the 200-day moving average breakout. And you definitely had to get out once it surged post earnings August. Now, this is bizarre to me. I haven't looked at the earnings for CDW, but look at this. It gapped down big time, which looked to validate or vindicate the bears, but then buyers stepped right in and surged it right over the 200-day moving average. So if you're bearish, you need to get out right around here and just step aside. And that would have saved you a lot of pain because today, following the market, it zoomed up another 3.8%. So I'm going to, like Cognizant, I'm going to be keeping a closer eye on CDW. This is some interesting trading actions for a stodgy old IT company. Something's going on important. I don't know what's indicating what, but I just want to keep my eye on it for any lessons. All right, I think I've covered enough. Actually, no, wait, two more. I keep saying that. Like I said, there's a lot of narratives in the market, and I'm just skimming the surface. Texas Instruments. This one looked very bearish. It even went down after earnings. And now that it's riding the coattails of the market sentiment, it's closed the gap. So technically that means for me that Texas Instruments is no longer bearish at a bare minimum, and it may be bullish, but it still has to fight through this serious downtrend. I wouldn't buy it until it closed above the 20-day moving average and perhaps even confirmed that breakout. If it does do that, then you have a lot of headroom going back up to 200-day moving average resistance. So another stodgy old tech company, but I want to keep my eye on it because of this potentially important trading action. And the last one on the list is good old Microsoft. I like this one because it had some important lessons here as well, just in terms of big caps. And this is a good place to end. After earnings, it popped up 3.1%. Then sellers took it down. This again, remember, this was last week. Last week was pretty bearish, and it was the end of October. And sellers took it right back down and filled that gap. Now, again, typically that means whatever people liked from earnings last time somehow is no longer valid or was just a fake move. But it was the sellers that got faked out because Microsoft held this 20-day moving average support, and buyers have been taking it right back up ever since. And now the good times are rolling. The post-earnings good times are rolling again. And this makes Microsoft a buy on the dips. I wouldn't buy it here because guess what? Hopefully you know already. It's overstretched above the upper Bollinger Band. Now, of course, it could just keep going up and up, but I just don't like the risk reward setup on those kinds of moves. So hopefully this has been helpful. I'm going to post this on my blog with the transcript for my readers. And for those of you who follow me on YouTube, or sorry, watching on YouTube, go ahead and follow me for more of these, what I call show and tells or chart reviews, because sometimes there's just so many narratives, I just can't write fast enough, and video becomes the best way to do that. For these long ones, you can use the transcript to fast forward to what's of more interest to you. And sometimes YouTube will provide the I forget what it's called, the timeline, to allow you to skip the things that look more interesting. So if you're still hanging in there, thank you for stopping through. Thank you for sticking through all these charts. And I will see you the next time. Again, my blog is drduru.com/122. Take it easy and have a good one.